Okay, picture this. You've just come up with $1 million business idea. It is absolutely brilliant, and you just know in your gut it's going to succeed. But there's one massive roadblock standing in your way right now. You have absolutely zero money to actually start it.
So what do you actually do? You've got this amazing vision, but no cash to make it real. Well, to launch your idea, you really only have two main choices. You either have to borrow the cash, or you have to convince an investor to believe in your dream. And look, this isn't just some theoretical exercise. This exact dilemma is the very foundation of how giants like Apple, Amazon, Tesla, and even your favorite local neighborhood restaurant came to exist. They all started with a huge vision and a desperate need for capital.
And that brings us to the whole point of this explainer, financing. By definition, financing is simply getting the money you need to start, run, or grow a business. It's the act of finding the funds you need. Honestly, it's the absolute fuel that keeps the entire economic engine running.
Here's our roadmap for today. First, the business funding problem. Second, why businesses need money. Third, the debt financing path. Fourth, the equity financing path. And fifth, debt versus equity in action.
All right, let's jump right into part 1, the business funding problem, or bridging the cash gap.
To make this super concrete, let's use a highly relatable example. Imagine you want to open up a brand new, beautifully designed coffee shop right in your town. You sit down, crunch the numbers, and you figure out that to cover the lease, commercial espresso machines, furniture, your staff, and marketing, you need exactly $50,000 just to get the front doors open. Now, let's say you've got personal savings of about $10,000. That's a great start, but you obviously need the full $50,000 to open up shop. Financing is simply the act of hunting down and acquiring that missing $40,000 gap. It's not magic, it's just practical gap filling.
Moving on to part 2, why businesses need money, otherwise known as fueling the engine.
Let's pull back and look at the broader picture here. Why do companies, even massive, billion-dollar ones, constantly seem to need more cash? Well, there are 5 major reasons. To start a new business, just like our coffee shop example. To buy heavy equipment and machinery to scale up. To expand into new cities or entirely new countries. To launch exciting new products to stay ahead of the competition. Or, honestly, simply to survive really difficult times when sales naturally dip. Basically, financing acts like a time machine. It accelerates time, letting companies grow aggressively right now without having to wait decades just to organically save up enough cash.
Which brings us to part 3, the debt financing path, borrowing with interest.
So the first major route is debt financing, and it's exactly what it sounds like. You borrow cash from a bank or a private lender, but you are strictly obligated to repay it over time. And of course, there's a little extra attached, which is the interest. Make no mistake, this is a binding contractual obligation.
Let's look at the math to really illustrate how this works. Say you borrow $100,000 to scale up your operations, and the bank gives you a 10% interest rate. That means after 1 year, you don't just owe that initial $100,000, you owe $110,000. You are quite literally paying a premium for the privilege of using their money today. Let's weigh the pros and cons here. The absolutely fantastic news? You keep 100% full ownership of your business. It is entirely yours, and no one gets to tell you how to run it. But the heavy downside? That loan must be repaid on schedule regardless of how successful you are. The bank doesn't care if your coffee machine breaks down or sales tank for a month. They absolutely expect their monthly payment. All right, let's look at the other side of the coin in part 4, the equity financing path, or sharing the pie. This is the completely different alternative. Instead of taking a loan from a bank, you bring in an investor. This person hands your money, but instead of demanding it back with interest, they take a piece of your company in exchange. They officially become your partner. Practically speaking, it works like this. An investor might look at your business and hand you that exact same $100,000 you need. But in return, they take, say, a 20% ownership stake. They now own a fifth of everything you do, forever. And this right here brilliantly illustrates the ultimate trade-off in business. Look at the upside. You are completely free from monthly loan payments. That stress-free cash flow is yours to use today to grow the business. But the downside? You share your future profits and your decision-making forever. Think about it. If your company absolutely explodes and later hits a $10 million valuation, well, that investor's original slice is suddenly worth $2 million. You essentially traded a piece of your massive future upside for that initial cash injection.
Let's actually see how this plays out in the real world. Part 5, debt versus equity in action, featuring Ali and Sarah.
Imagine 2 friends, Ali and Sarah, and they launch identical companies. Ali decides to take the debt financing path. He borrows $100,000 from a bank, meaning he has a strict obligation to repay that loan plus interest. Sarah, on the other hand, goes with equity financing. She raises her $100,000 from an investor, meaning she has zero obligation to repay the cash. So, two identical businesses, but two entirely different financial foundations.
Okay, fast forward 5 years into the future. It's a wildly successful outcome for both of them. All their hard work paid off. Both of their businesses are now valued at exactly $1 million. But let's see how their initial funding choices actually affected their personal payouts.
Starting with Ali. Because he used debt financing, he steadily paid off his bank loan out of his operating profits over those first few years. And now, he still owns 100% of his million-dollar company. That entire pie is his. By keeping his equity and taking on that initial debt risk, he earned significantly more wealth in the long run.
Contrast this with Sarah. Her business is also worth $1 million, but look at the split. She now only owns 80% of it. Her investor permanently holds that 20% stake they bought at the very beginning. So Sarah's share is worth $800,000, while her investor walks away with a cool $200,000 for taking that early leap of faith on her.
But, we really must flip the scale to the risk side for a second, because obviously not every story is a success. What if the businesses failed? If they both had zero customers and went bankrupt, Ali would be trapped. He still owes the bank money, and they are going to expect repayment. Sarah, however, because she used equity, she doesn't have to repay her investor a single dime. The investor knew the risks and simply shares the loss with her. Sarah gets to walk away with zero debt. So, to summarize all this, the big takeaway is that the smartest businesses choose the option that fits their specific goals, their cash flow, and their future plans. Neither option is universally better. Small, steady cash flow businesses often use bank loans so they can maintain total control. High-growth, super risky tech startups, they almost always use equity from investors. And the most massive, successful companies in the world actually use a highly strategic combination of both at different times in their life cycle. All right, bringing this all together, now that you fully understand the mechanics behind terms like venture capital, bank loans, and fundraising from this explainer, I want to leave you with one final thought to ponder. If you were sitting on the next $1 million idea right now, looking at the risks and the massive potential rewards, which path would you choose to fund your future?